Thank you very much, Ran, for the presentation. Jason, you go first, or Amos?
Jason, always.
Jason. You're looking for the next job, I think.
I want Amos to tell us about the secret U.S.-Saudi deal.
Right, exactly. Jason, please.
No, it was public.
Go ahead, Jason.
Are we? I didn't really. Do you have a question, or you want me to just speak generally about the price decline?
Yeah.
Okay.
Generally.
I think this was unexpected. I think most people in the market would tell you that. If you're in the U.S. right now and in Houston or North Dakota, there's a great sense of concern and unease. Energy companies have taken a big hit. The stock market has also taken a hit, I think, because people view the decline in the oil price as a signal of broader global weakness more than a supply-side story, even though I think supply has probably had a bit more to do with what we have seen recently. With U.S. supply, 4 million barrels a day coming online rather quickly, Libya coming back in October, that helped give people a little bit of a psychological feeling that some of the disrupted supply was going to come back, although Libya has fallen back again, and it'll probably just swing back and forth as kind of a failed state for a while. And then continued kind of, weak economic numbers coming out of places like China, from the IMF and elsewhere. On the whole, as we heard, this is a good thing for major consumers. It's a good thing for the U.S. economy. I wrote a note about 2 weeks ago with Jim Stock, a former member of the President's Council of Economic Advisors, and we put the GDP bump next year at between 0.2 and 0.4 percentage points. So we heard 0.3, so that's consistent. I think Citibank has it at 0.4 to 5, Goldman at 0.3 to 4, so somewhere in that range. This is good for the economy. It's good for consumers. At this price level, this is around $1,000 per household per year tax cut back in families' pockets just before the holiday season. But from the U.S. standpoint, I had a reporter call me after the OPEC meeting. A reporter asked me, "Do you think the U.S. will try to persuade the Saudis to cut?" Which was a shocking example of how the U.S. landscape has changed, that someone would even think that's a reasonable question to ask. Because we kind of thought low oil prices were a good thing, and we sort of thought that a cartel's manipulation of the global oil market was a bad thing, but somehow now, because we're a much larger energy producer, there are different winners and losers. And so on the whole, it's a good thing, but there are losers as well as a result of the fact that we're producing much more, and some of that is high-cost supply. I think I mentioned earlier in the day that the break-even cost for U.S. shale from all the analysts always seems to be $10 below whatever the price is today, and that just keeps coming down. So I think we're seeing that U.S. shale is pretty resilient. We don't know exactly what this is going to look like. We've seen announcements of cutback in capital expenditures, Conoco 20%. Several other companies over the next month or two will announce their capital investment plans for next year, and I suspect we'll see modest to large reductions in capital investment for next year. That does not mean U.S. production doesn't grow. It probably grows more slowly than would otherwise be the case. But given how rapidly the productivity improvements are taking place in U.S. shale production, the fact that 70% of the production comes from around 30% of the wells, and you can focus on the sweet spots. We have about 10,000 wells in the U.S. that have been partially drilled but not completed, and you can go back to those. I think the Energy Information Administration projects continued growth through roughly the summer, and then the growth rate starts to slow after that at these price levels. And obviously, these price levels could change in response to increased demand, in response to some supply coming off the market elsewhere. And we heard mention of, announcement of Chevron canceling a project. Those are longer-term things, but some short-term response. And then, geopolitical risks. So we saw 2 oil ports in Libya shut down in response to violence and fighting over the weekend. And obviously, there's a lot of geopolitical risk in the world. I think what's interesting is, I saw Citibank sent a note out, I think, yesterday or today, and they always try to come up with a catchy phrase for their note, and this one was like the call on shale. So we always talk about the call on OPEC, but if how does this play out, and do we start to think of shale oil, which, unlike conventional oil, can be ramped up and down very quickly because of how steep the decline rates are? Does that start to be a sort of market swing producer? And if that's the case, what does that mean for how we think about the role that OPEC has traditionally played, and whether it's even played as much of a role as people think is something we, is up for debate, and whether it's actually had the power that people ascribe to it. And then geopolitically, we talked today already about what it means for Russia and their economy on the brink of collapse, the collapse of the ruble as a combination of sanctions and low oil prices, for Iran, for Venezuela, for Nigeria. These are countries that face a severe, if not existential threat, I think, from very low oil prices, and trouble managing that over time. Because again, even if we start to see some U.S. production cut back, as soon as prices rebound, that production can come back very quickly, like an accordion, and expands and contracts quickly. And that's going to present a challenge, I think, for the short to medium term for those countries. When you look out, a decade or more beyond, we're still going to need a lot of supply coming from OPEC countries, to be sure. But these are countries that have struck a social bargain in their country and in their region that requires at least 100, in some cases up to 130 or 140 oil price to maintain. And if you're Venezuela or you're Nigeria, your economy has the potential to really fall into chaos next year. And I think that's something that, in terms of the spillover effects and the instability, it's really important for policymakers to focus on. So those are a couple of initial observations, but happy to respond to whatever you want to talk about.